Our featured guest is Hans Olsen, the Chief Investment Officer at JPMorgan Private Wealth Management. And Hans, let's kick things off with you. Where do we start? The president today, certainly, putting more pressure on an already downward market. Rightfully so, in your view?
Well, the news flow was really difficult today. Markets down broadly. In fact, Carol, I was looking at this earlier. The only markets that are the only sectors of the market up today would be leisure and recreation, airlines being up the most, so people want to get out of town, and the rest are bar and restaurants. So it kind of sets the tenor for things. I think the timing is kind of difficult. We're still in the early stages of recovery. Right. The market is settling in against the backdrop of economic recovery that's still kind of weak, and to be heading in this direction, the timing's tough.
It's interesting because I remember kind of late last year, everybody said, wait till early next year. Everybody will remember, okay, we've got some problems still out there, whether it's healthcare, whether it's financial reform, whether it's still a weak economy. I mean, they're fundamentally still out there. They haven't gone away.
That's true. I mean, if you look at Q3 earnings, right? GDP came in at 2.8%. You strip out cash flow clunkers, and you are 1.8%. That's the first positive print coming out of the worst recession since the Great Depression. That's a weak print, and if in these big numbers that people are talking about in Q4, 4 or 5%, a good portion of that is a reduction in the inventory drawdown. So the quality of growth there, pretty questionable.
So what happens? I had Joe Lavorgny of Deutsche Bank Securities on this week. He's pretty aggressive, very bullish on the economy. He talks about 6% growth. As you know, I think consensus is something like 2.7%. Yeah. Is that just crazy in your view?
We'd love to see that he's right. Hard to argue with that. But yeah, it's probably pretty aggressive because the big question is, what's the organic growth out there when you take away all the stimulus? No one really knows at this juncture. And so the questions that are being asked for corporate earnings, the quality of corporate earnings, can rightly be asked of the quality of overall economic growth in the U.S.
And I want to ask you, Hans, about the quality of corporate earnings. We have gotten some reports. We're waiting for Google today, but we've gotten some big names. The financials have reported. How do you think they're doing so far?
Well, only 11% have reported. And
it's early on.
And it's early on, but, the trend is good. So far, so good.
Good enough for the markets to keep going higher? I mean, they're obviously not the last couple of days. Stay where they are. I mean, safe to say, after the tremendous run that we've seen, that we should see some pullbacks.
Yeah, I think you're right. You're right. So this, I think 2010 will be a year in which markets function as markets should. They're discriminating mechanisms, right? They discriminate between investments that should be funded and investments that shouldn't be.
Right.
And I think that's the environment that we're likely to find ourselves in this year. So if markets are rather muted, they're going to be muted because they have to digest uncertainty.
Right. That's fair.
Yeah.
Well, I just want to bring in what Nouriel Roubini said earlier today in Hong Kong. Carol alluded to this earlier because he's also looking out further in the year, and he sees 4 things that are going to be a threat to a continued rally in stocks. He talks about a muted economic recovery among the largest economies in the world. He talks about deflationary pressures that then may feed through to corporate earnings and put pressure on corporate earnings. And he talks also about something that's been talked about a lot, all these asset bubbles potentially in the emerging markets and the fallout from that. So I believe we have a little bit of what he had to say earlier today.
By the second half of the year, there's going to be a slowdown in growth in the U.S., Europe, and Japan. I think that could be the beginning of a market correction because the macroeconomic news are going to surprise on the downside, because even the earnings news are going to surprise on the downside.
So, Hans, I guess the question is, how big is the risk that we don't just kind of muddle along this year, but that we actually do see more of a decline in stocks and other types of assets for that matter?
Well, I think, I kind of have to say I agree with part of what Roubini said.
Which part?
The growth being slower in the second part of the year, and then it sort of puts the emphasis on corporate earnings. I don't. The worries about deflation and the like, I'm not so sure that, that would be at the top of our list. And I don't think it would be the worst thing if we had a year in which equity markets went sideways. right? I mean, not every year can be a 20% plus year. Back in 2005, that year the market was up 6%.
Right.
And it allowed higher returns in subsequent years. So I don't think it would be the worst thing in the world. It's certainly tough to talk about with clients, that's for sure. But it's probably not a bad thing to sort of consolidate the gains.
All right, Hans, what do you make of that the institutional guys are now coming into the market doing a lot of selling here?
Yeah, they're taking the risk out of the portfolio. Yeah, I mean, it's a part and parcel of higher uncertainty, right? Markets detest uncertainty. What you've had is higher levels of uncertainty infused into the market. Seen the VIX tick up, which I'm sure Larry will talk about, and I think this is emblematic of that.
Right. So Hans, a lot of selling, like you said, though, maybe this is kind of what we need to see, some of this selling. Do you think it's going to continue?
Well, again, back to this sort of uncertainty theme, sure. As the market digests what was talked about today, what the president talked about today, some of the elections up in Massachusetts earlier in the week.
A lot more uncertainty back.
There's a lot more uncertainty there. So yes, I think, though, as we move into next week and the week after, we're going to toggle back to what's up with earnings. Because at the end of the day, this is all about earnings.
What do you make of Google's earnings?
Directionally be on the top and the bottom line. That I would think that would be good. I don't get the.
It's kind of interesting, the disconnect
kind of,
maybe here.
Yeah, that they're hitting the bids in the aftermarket. It could be back to the old trader's aphorism. You sell on the good news.
Right, exactly. And Julie had mentioned it was trading higher. It is good though to see companies beating on both the top and the bottom line. Something we weren't seeing in the last few earnings cycles, if you will.
Right. And this gets back to that quality of earnings. So we saw an improvement in the trend of revenues in Q3. It's very important that we see that continue on in Q4. That will support higher earnings, on the bottom line. There's a great deal of operating leverage that's been priced into U.S. stocks. During this recession, companies cut about 80 cents for every dollar of lost revenue. So the earnings,
huge.
Yeah, it's huge, and the earnings spring has really been set. All you need is some driver on the top line, really, for it to manifest itself in the bottom line.
Exactly. Here we have two companies that seemingly have done better than expected, yet we've got the stock trading down in the aftermarket. Is it just a sign of some nervousness coming back to the market here? Yeah,
this is risk shedding is what it is, because these numbers, top line, bottom line beats, it's people just unloading risk positions.
Right.
The thing about this with the announcement today, and I was thinking about this earlier, after I heard the president speak and talking about wanting banks to lend more, and we went back and we looked at the National Association of Independent Businesses, Small Business Federation, which accounted for like 60% of employment growth over the last 20 years or so. And they score these things, and what they said is that they admit the scoring was financing is harder to get. 92% of the respondents were talking about financing being adequate or not being an issue for them.
Interesting.
Only 8% said they had need for financing, and only 4% of that said that they were concerned about it. And when they scored the primary concerns for the small business sector, the first thing was poor sales, so consumers showing up and buying things. The second was taxes, and the third would be regulation and red tape.
Well, there you have it.
It's kind of an interesting dichotomy.
Yeah, absolutely. Hey,